The American dream of homeownership just hit a wall nobody saw coming. For years, sellers ruled the market with an iron fist. Bidding wars were standard. Homes sold in hours, sometimes for tens of thousands above asking price. Cash offers poured in from every direction. If you owned property, you basically had a money printer in your backyard. But 2025 has shattered that illusion completely. If you want to stay ahead of the biggest housing shifts happening right now, hit that subscribe button because what's unfolding in these markets is just the beginning. Let's dive in. Number 11. Bozeman, Montana. Bozeman became the ultimate pandemic darling. Tucked against the Rockies with wide open spaces and that rugged western charm, it attracted everyone fleeing crowded cities. Tech workers cashed out of San Francisco. Retirees sold in Seattle. Investors saw opportunity and poured money into what felt like the next Aspen. Home prices doubled, sometimes tripled, in less than 3 years. A modest ranch that sold for $400,000 in 2019 was suddenly worth $900,000 by 2022. Number 10. Spokane, Washington. Spokane was supposed to be the affordable alternative to Seattle, a smaller city with solid jobs, lower costs, and just enough culture to keep things interesting. For years, it quietly hummed along, attracting families and retirees looking for stability without the chaos. But when the pandemic hit, Spokane got swept into the same speculative mania that gripped the entire Pacific Northwest. Californians and Seattle refugees flooded in, driving prices up nearly 50% in 2 years. Homes that sat on the market for weeks were suddenly gone in days, often with multiple offers over asking. Developers rushed to build, convinced demand would stay strong indefinitely. It didn't. By 2025, Spokane's housing market is in freefall. Prices have tumbled about 14% and inventory is stacking up fast. Number 9. Reno, Nevada. Reno rode the same wave as its flashier cousin Las Vegas, but with a twist. It positioned itself as the cooler, more livable alternative. Close to Tahoe, no state income tax, and a growing tech presence thanks to companies like Tesla setting up nearby. For a few years, it worked beautifully. Californians fleeing the Bay Area's cost of living poured into Reno, treating it like a discounted version of the life they left behind. Home prices shot up over 60% between 2020 and 2023. Builders scrambled to keep up, filling the desert with tract homes and luxury townhouses. But by 2025, the boom has officially turned into a bust. Prices are down roughly 13%, and the decline is accelerating. Homes that were considered solid investments are now financial anchors, dragging owners into negative equity. The California exodus has slowed to a trickle. Remote work policies that made Reno attractive have been rolled back. And the tech jobs that were supposed to sustain the market have evaporated in waves of layoffs. Meanwhile, the cost of living in Reno has spiked. Property taxes have surged as local governments try to fund infrastructure for a population that grew too fast. Insurance premiums have skyrocketed due to wildfire risks, and utilities, strained by rapid development, keep raising rates. For many transplants, Reno no longer offers the financial relief it once promised. Now they're selling at a loss and heading back to California or trying cheaper states altogether. The housing developments that sprang up in outlying areas like Spanish Springs and Cold Springs are taking the hardest hits. Entire blocks of homes sit unsold, prices slashed repeatedly with no takers. Investors who snapped up properties hoping to flip or rent them out are stuck holding the bag, unable to offload assets that are declining in value every month. Reno's story is a stark reminder that proximity to desirable locations doesn't guarantee stability. When the fundamentals don't support the hype, even the next big thing can crumble fast. Number 8. Provo, Utah. Provo seemed untouchable for the longest time. Nestled in Utah Valley with a young, growing population fueled by Brigham Young University and a surging tech corridor, it was hailed as one of the best places to live and invest. Families loved the mountain views and strong community. Investors loved the appreciation rates. Between 2019 and 2022, home prices soared nearly 70%, making it one of the hottest markets in the entire country. But in 2025, that momentum has completely reversed. Home values have dropped about 16% from their peak, and sellers are in full panic mode. The issue is twofold: oversupply and fading demand. Developers built thousands of homes assuming the influx of buyers would never stop. Subdivisions sprawled across every available patch of land, from Orem to Spanish Fork. But the buyers stopped coming. Remote workers who moved in during the pandemic are leaving, as companies call them, back to headquarters. The tech sector, which was supposed to be Provo's economic engine, has cooled significantly. Layoffs and hiring freezes mean fewer high-income professionals hunting for homes. At the same time, affordability has become a crisis. Even with prices dropping, the average home still costs far more than what local wages can support. Young families, the core demographic that drove Provo's growth, are being priced out or choosing to rent indefinitely. First-time buyers who stretched their budgets in 2022 are now underwater, unable to sell without taking devastating losses. Many are simply walking away, letting properties slide into foreclosure rather than continue bleeding money. The rental market hasn't provided any relief either. Landlords are struggling to find tenants willing to pay the rents needed to cover mortgages on homes bought at peak prices. Vacancy rates are climbing, and rent cuts are becoming standard. For a city that built its reputation on family values and stability, the financial chaos is deeply unsettling. Provo's fall is proof that even the most beloved markets aren't immune when speculation takes over and reality pulls back the curtain. Number 7. Cape Coral, Florida. Cape Coral is a sprawling maze of canals, retirement communities, and pastel-colored dreams that attracted waves of retirees and investors for decades. It's Florida's version of accessible paradise, waterfront living without Miami's price tag. During the pandemic, it became a magnet for Northeasterners cashing out and heading south. Home prices jumped over 50% in less than 3 years. Developers expanded aggressively, convinced that demand from boomers and remote workers would sustain growth indefinitely. But 2025 has delivered a harsh awakening. Home prices have fallen nearly 15%, and the market is choking on inventory. Sellers are slashing prices by $50,000, $75,000, even $100,000, and homes are still sitting untouched for months. The problem isn't just oversupply, it's the mounting costs of owning property in Florida. Insurance premiums have exploded, tripling or even quadrupling in some neighborhoods. After Hurricane Ian and a string of devastating storms, insurers either fled the state entirely or jacked up rates to levels that make homeownership unaffordable. HOA fees are skyrocketing as communities scramble to fund repairs and meet new building standards. Property taxes keep climbing, and for retirees on fixed incomes, the numbers simply don't work anymore. Many are selling and leaving Florida altogether, heading to states with lower costs and fewer climate risks. The investor class that flooded Cape Coral is bailing out too. Short-term rental operators who bought multiple properties are dumping them as vacation bookings dry up and expenses pile higher. Flippers who expected quick profits are stuck with homes that won't sell, even at steep discounts. And the new construction that was supposed to attract wealthy buyers is sitting empty, a glaring symbol of misplaced optimism. The canals that once symbolized leisure and luxury now feel like a burden. Maintenance costs are brutal, and the environmental risks are becoming impossible to ignore. For Cape Coral, the dream of endless sunshine and waterfront retirement has collided headfirst with financial reality, and homeowners are paying the price. Number 6. Tacoma, Washington. For years, Tacoma lived in Seattle's shadow, overlooked and underestimated. But when Seattle's prices became completely unhinged, Tacoma became the escape hatch. It offered proximity to the city, a waterfront, and prices that seemed reasonable by comparison. Buyers poured in, treating Tacoma like Seattle's discount bin. Homes that sold for $300,000 in 2019 were suddenly worth $600,000 by 2022. Developers jumped in, building new housing at a breakneck pace, convinced the demand was rock solid. It wasn't. By 2025, Tacoma's housing market is unraveling. Prices have dropped about 12%, and the slide shows no signs of stopping. The Seattle tech workers who drove demand are either gone or stuck in their own underwater mortgages. Layoffs at Amazon and Microsoft didn't just hurt Seattle, they gutted Tacoma's buyer pool too. The commute that once seemed manageable now feels pointless as remote work fades and companies demand in-office attendance. For those who bought at the peak, the situation is brutal. Equity has evaporated. Refinancing is nearly impossible with current rates. And selling means accepting a loss that wipes out years of savings. Many are choosing to hold on and hope, but hope doesn't pay the mortgage. New developments in South Tacoma and around the port are struggling the most. Rows of new townhouses and condos sit unsold, builders offering incentives that would have been unthinkable 2 years ago, price cuts, closing cost coverage, even furniture packages. But buyers aren't biting. The market has shifted, and Tacoma's appeal as the affordable alternative has faded now that prices are falling everywhere. Even the rental market is softening. Investors who bought properties expecting strong cash flow are now cutting rents and still facing vacancies. The stability Tacoma was supposed to offer has turned into volatility, and homeowners are caught in the middle, watching values drop while costs keep climbing. Tacoma's collapse is a painful reminder that being cheaper than Seattle isn't a strategy. It's just a temporary position that evaporates the moment the bigger market stumbles. Number 5. Sacramento, California. Sacramento was California's great hope, the capital city where you could still afford a home without selling your soul. It drew state workers, young families, and Bay Area refugees who wanted space and a backyard. During the pandemic, Sacramento's market went absolutely nuclear. Homes that listed on Friday were gone by Monday, often $100,000 over asking, all cash, no contingencies. Prices soared nearly 45% in 2 years. It felt like the boom would never end. But in 2025, Sacramento is in full retreat. Home prices have fallen about 14%, and listings are piling up faster than buyers can absorb. Sellers are cutting prices weekly, sometimes multiple times, just to generate interest. The Bay Area transplants who fueled the surge have mostly stopped coming. Tech layoffs have crushed that pipeline. And the remote workers who thought they'd found paradise are realizing Sacramento's summers are brutal, the infrastructure is strained, and the cost savings aren't what they expected. Property taxes have jumped as valuations soared. Insurance is climbing. And the state's overall cost of living continues to rise, eroding any financial advantage Sacramento once offered. For many, it no longer makes sense to stay. The exodus is quiet but steady, and it's bleeding the market dry. New subdivisions in Elk Grove, Natomas, and Roseville are struggling. Builders are sitting on unsold inventory, slashing prices to move units before financing costs bury them. Homes that were supposed to attract first-time buyers are out of reach even with the cuts. Wages haven't kept pace, and affordability is still a major barrier. Investors are pulling back too. The rental market has softened significantly, and cash flow projections that looked solid in 2022 are now underwater. Landlords are selling at a loss rather than continue funding negative returns. Sacramento's story is especially painful because it was supposed to be the sustainable option, the city that balanced growth and affordability. Instead, it became another casualty of speculative excess, a reminder that in California, no market is safe when the broader economy shifts. Number 4. Boise, Idaho. Boise's housing crash might be the most dramatic on this list because the fall has been so steep and so fast. Just 3 years ago, Boise was the hottest market in America. Migration from California, Oregon, and Washington turned it into a cultural and financial phenomenon. Home prices rocketed up over 60% between 2020 and 2022. Builders couldn't keep up. Buyers were offering $50,000, $75,000, even $100,000 over asking just to secure a property. The city's charm, outdoor access, and lower taxes made it irresistible. But by 2025, the dream has shattered. Home prices in Boise have plummeted nearly 20% from their peak, one of the steepest drops in the country. Sellers are slashing prices by staggering amounts, and even then, homes are sitting for months with little to no interest. The out-of-state buyers who inflated the market have disappeared. Remote work policies that made Boise viable have been rolled back. And the locals who were priced out during the boom still can't afford to buy, even with prices falling. Wages in Boise never supported the inflated values. The market was built entirely on external demand, and when that demand evaporated, the foundation collapsed. New neighborhoods in Meridian, Eagle, and Nampa are ghost towns. Streets of brand new homes sit empty, many with price-reduced signs that have been updated so many times the original asking price feels like ancient history. Builders are walking away from projects, investors are dumping properties at massive losses, and small-time flippers who thought Boise was a sure thing are filing for bankruptcy. The ripple effects are hitting the broader economy too. Restaurants and shops that thrived on newcomer spending are closing. Construction jobs have dried up. And the tax base that local governments were counting on to fund infrastructure is crumbling as property values decline. Boise's collapse is a textbook case of what happens when a small market gets swamped by speculative fever. The city couldn't handle the volume, and now it's paying the price. For homeowners stuck holding the bag, it's a financial disaster that will take years to recover from, if recovery even comes. Number 3. Austin, Texas. Austin's fall from grace has been nothing short of spectacular. The city spent years branding itself as the next Silicon Valley, and for a while, it genuinely seemed unstoppable. Tech giants relocated, startups flooded in, venture capital poured into every corner, and the housing market responded with a frenzy that made national headlines. Home prices jumped over 50% in less than 3 years. Buyers were throwing cash at anything available, convinced Austin's growth was infinite. But 2025 has been a brutal reality check. Home prices have dropped about 17%, and in some neighborhoods, the decline is closer to 25%. Sellers are cutting prices aggressively, sometimes multiple times in a single month, and still struggling to find buyers. The tech sector that fueled Austin's rise has imploded. Massive layoffs at Tesla, Oracle, Meta, and dozens of startups have gutted the high-income buyer pool. The well-paid engineers and executives who drove demand are either gone or too financially unstable to buy. And the investors who treated Austin like a gold mine are now desperately trying to exit before losses get worse. New developments across the metro are in crisis. Luxury communities in places like Westlake, Round Rock, and Cedar Park are sitting half empty. Builders are offering incentives that border on desperate, closing cost coverage, rate buydowns, even free upgrades. But the demand just isn't there. Affordability is still a massive barrier, and the speculative fever that made people overlook fundamentals has completely cooled. The short-term rental market has collapsed too. Austin passed strict regulations limiting Airbnbs, and owners who bought properties specifically for that purpose are now stuck with homes they can't rent and can't sell. Many are simply walking away, letting lenders take the properties back. For a city that built its identity on relentless optimism and growth, the current downturn feels like an identity crisis. The music, the culture, the Keep Austin Weird spirit are all still there, but the financial foundation has cracked wide open. Homeowners who bought at the peak are trapped, watching equity vanish while costs keep climbing. And the market shows no signs of stabilizing anytime soon. Number 2. Phoenix, Arizona. Phoenix was the Sun Belt's shining star, the city that symbolized endless expansion and opportunity. For years, it attracted retirees, young families, and investors, all drawn by sunshine, affordability, and a booming economy. But Phoenix's housing market didn't just grow, it exploded. Between 2020 and 2023, home prices surged nearly 60%. Builders went into overdrive, constructing tens of thousands of homes across the valley. Scottsdale, Chandler, Gilbert, Mesa, every corner of the metro was covered in cranes and construction sites. It felt like the growth would never stop. But in 2025, Phoenix is drowning in oversupply, and prices are collapsing. Home values have dropped about 16%. And in some suburban areas, the decline is over 20%. Sellers are slashing prices by $75,000, $100,000, sometimes more, and homes are still sitting on the market for months. The problem is simple. Builders created far more inventory than the market could absorb. New subdivisions are filled with unsold homes, entire streets with no residents, just empty houses baking in the desert sun. Builders are offering massive incentives, but buyers are hesitant, knowing that prices are still falling and waiting might get them an even better deal. The investor class that fueled Phoenix's boom has pulled back entirely. Institutional buyers who snapped up thousands of homes are now selling, flooding the market with even more inventory. Individual investors who bought hoping to rent or flip are stuck with properties that won't move. Insurance costs have skyrocketed due to extreme heat and rising climate risks. Property taxes are climbing as local governments try to fund infrastructure for a population that grew too fast. And water scarcity is becoming a real concern, scaring off long-term buyers who worry about Phoenix's sustainability. For homeowners who bought in the last 2 years, the situation is devastating. Equity has disappeared. Many owe more than their homes are worth. Refinancing is impossible with current rates, and selling means accepting losses that wipe out down payments and savings. Phoenix's collapse is a powerful lesson about the dangers of unchecked growth. The city that built its reputation on sunshine and optimism is now facing a harsh reality. When supply overwhelms demand and costs spiral out of control, even the brightest markets can go dark. Number 1. Las Vegas, Nevada. At the top of the list is Las Vegas, a city that's no stranger to booms and busts, but the current housing collapse feels different, more severe, more prolonged, and more painful. Between 2020 and 2022, Las Vegas home prices skyrocketed over 55%. Californians fleeing high taxes and housing costs poured into the valley. Investors saw opportunity and bought everything in sight. Builders raced to keep up, filling the desert with subdivisions as fast as they could pour concrete. It seemed like the party would never end. But by 2025, the music has stopped, and the hangover is brutal. Home prices have crashed nearly 19% from their peak, and the decline is accelerating. Sellers are cutting prices by 6 figures, and still can't find buyers. Listings are stacking up across the valley, from Summerlin to Henderson to North Las Vegas. The market is completely saturated, and desperation is setting in. The California migration that drove the boom has reversed. Many transplants are heading back, unable to handle the heat, the limited job market, or the rising costs. The service industry jobs that sustain Las Vegas don't pay enough to support home ownership, especially at the inflated prices of recent years. And tourism, the city's economic backbone, hasn't fully recovered. Fewer conventions, softer casino revenues, and reduced consumer spending mean less money flowing through the local economy. Investors are in full retreat. The institutional buyers who dominated the market are selling off portfolios. Individual investors who bought hoping to profit from short-term rentals are drowning in expenses as bookings dry up and regulations tighten. Many are abandoning properties, walking away from mortgages rather than continue losing money. New construction is a disaster. Entire neighborhoods of brand-new homes sit unsold, prices slashed repeatedly with no interest. Builders are bleeding cash, and some are facing bankruptcy. The desert landscape is now dotted with half-finished projects, silent monuments to overconfidence and miscalculation. Insurance premiums have spiked. HOA fees are rising, and property taxes are climbing even as home values fall, creating a financial squeeze that's unbearable for many owners. For a city built on risk and reward, the current housing market feels like a losing hand that won't end. Las Vegas homeowners are trapped, watching values plummet while costs keep climbing, and the market shows no signs of stabilizing. The crash is deep, widespread, and brutal, making Las Vegas the epicenter of America's housing correction in 2025. What we're witnessing across these 11 cities isn't just a market adjustment. It's a fundamental shift in how housing works in America. The speculative frenzy that defined the pandemic era has collapsed, leaving millions of homeowners stuck in properties worth far less than they paid. The dream of easy wealth through real estate has evaporated, replaced by the harsh reality of falling prices, rising costs, and vanishing buyers. For sellers, this is a nightmare. For buyers, it's an opportunity, but one shadowed by uncertainty. Will prices keep falling? Are we catching a falling knife? The truth is, no one knows. What's clear is that the era of guaranteed appreciation is over. The cities on this list are learning the hardest lesson in real estate. What goes up can come down just as fast, and sometimes even faster. If this breakdown gave you a new perspective on where the housing market is headed, make sure you're subscribed because the story is far from over. From The collapse we're seeing today is going to reshape home ownership, investment strategies, and entire local economies for years to come. And as always, the data doesn't lie.